Hi children, today I am going to start a new lesson. It is economics lesson and the title of the lesson is Credit in the Financial System. Credit means loans. Now let us start the lesson. People, whenever they need money, they borrow from their friends, relatives, money lenders, banks, etc. Whichever source is possible for them, they get their loans from that source, either money lenders, banks, relatives, friends, etc. And agricultural laborers, they borrow from their employers, money lenders, etc. And when they borrow from their employers, sometimes they work for less wages till the loan is repaid. They are made to work. They are made to work till the loan is repaid, and they are paid low wages. And different kinds of credit arrangements are an important component of country's financial system, and they play a very crucial role, because when people get money for their needs, they can fulfill their needs and also they can make some development. If they want to invest and they want to start any small cottage industry, whatever purpose it may be, they can fulfill their needs and they can contribute to the country's development. Their standard of living will be increased. Now, like this, the different kinds of credit arrangements are an important component of country's financial system, and they play a very crucial role in the country's development. Now, in this chapter, we are going to learn about some of these credit arrangements and advantages or disadvantages thereof. To start with, bank deposits as money. Currency, coins and bank deposits, they form modern forms of money. All these currency, coins and bank deposits, they form modern forms of money. And banks mainly perform two types of functions. The first one is accepting deposits from the people, and the second one is extending loans to the needy people. Accepting deposits and extending loans. And if we deposit our money in bank, it is safe. Everyone knows it. And also the banks pay interest on these deposits. So we can earn money. At any time, people can withdraw money from their deposits in the bank. Since money from the deposits can be withdrawn on demand, these bank deposits are also known as demand deposits. Bank deposits are also known as demand deposits. Why they are known as demand deposits? Because money can be withdrawn from the bank account on demand. When we demand, the banks pay our money to us. It is called as withdrawal. We can withdraw our money on demand. So these banks deposits are also known as demand deposits. And these demand deposits provide another facility, and that is they act as medium of exchange. Just like money. Just like money acts as medium of exchange, if we want to exchange anything between people, we use money as a means of exchange, medium of exchange. Money is a medium of exchange. Just like money, these bank deposits also, they act as medium of exchange. We can withdraw money in cash from the bank, and we can also make payments to anyone by a means of a check or draft. If we want to give, suppose 5,000 to any person, we can give a check in his name, and then he can encash this check in any bank. In the same way, we can give a draft also. So by means of check or draft, we can make payments from our bank deposits. And that is why the bank deposits or demand deposits, as they are known, they constitute money, because they work like medium of exchange. Just like money, they act as medium of exchange. We can make payments and we can also receive payments. So they constitute money. These bank deposits, they constitute money. Now the entire banking system is supervised by the RBI. RBI means Reserve Bank of India. And the RBI issues guidelines to all the commercial banks. Commercial banks means all these Canara Bank, Union Bank, State Bank of India, all these banks are called commercial banks. And for all these banks, the RBI issues guidelines. And it also frames rules and regulations for the functioning of banks. And all the banks have to follow these rules and regulations. The rate of interest to be paid by the bank on deposits is fixed by the RBI. And as we already discussed earlier, the banks also give loans to the needy people. And on these loan amounts, the bank collects an interest. And this rate of interest to be charged on loan amounts by the banks is also decided by the RBI. And the RBI also supervises the functioning of the banks and ensures that people's trust in banks is maintained. Because people believe that whenever they want, they can deposit their money, and whenever they want their money for their needs, they can get a withdrawal from their bank account. And this, to maintain this trust, they have to work properly. And the RBI supervises to see that the banks function to maintain this people's trust in banks. And it also looks after the supply of currency notes and coins to the banks, whether it is adequate or not, and whether it is in good condition. This is supervised by the RBI. Now in this picture you can see on the left hand side there are some people who are depositing their money in the bank. After getting profits from his business, one man is depositing money, and after harvesting the crop, the farmer gets profits, so he is depositing in bank. And another lady, after getting salary, she is working somewhere, she is getting salaries, and after getting salary, she is depositing in the bank. And in return, these people are getting interest from the bank. And in the other picture, you can see some people are taking loans for different purposes, for purchasing a car, for purchasing tractor, for purchasing some other goods, for building house. They are taking loans from the bank. And on these loan amounts, they are paying interest to the bank. Now, accepting deposits from the people is the primary function of banks. What do the banks do with these deposits? And as the banks, they are collecting much money in the form of deposits. Of course, they are paying interest, but what does the bank do with these deposits? As the banks pay interest on these deposits, it's a benefit to the depositor. And what does the bank do with the deposit amounts? All the banks keep only a small proportion of their deposits as cash. And this they do to facilitate withdrawals from the bank accounts. If any depositor wants to withdraw some money from his or her bank account, banks can keep their promise of allowing withdrawal at any time. Because we can withdraw our amount from the bank account at any time, the banks keeps some part of their deposits as cash in their bank so that they can meet the needs of these withdrawals. Suppose 4 or 5 people come for withdrawing money. The bank should have some cash to give the withdrawal to the depositors. So it keeps some percentage of the total deposits as cash. And at present, all the banks, they hold 15% of their deposits as cash. Only some of the many depositors come to withdraw money on any particular day, so the banks can meet requirement of cash for withdrawals from this cash. Now, major portion of the deposits are used by banks to extend loans. 15% is kept as deposits in the bank, and it is used to meet the requirements of withdrawals on any day. And the major portion of the deposits, they are used by banks to extend loans. On one side, it accepts deposits from the depositor, and the same money is given as loans to the needy people. For various economic activities, loans are given by the bank. And in this way, banks act as a mediator between those who have surplus funds. Those who have surplus funds, they deposit in bank. And this money of deposits is mobilized to give loans to the needy people. And those who need loans from the bank, they are borrowers. They are borrowing from banks, so they are borrowers. So between depositors and borrowers, the banks mediate. They act as mediators, accepting deposits from the depositor and then extending loans to the borrowers. And on these loans, the banks charge a very high rate of interest from the people than what the banks pay on deposits. So the difference between these two rates of interest, that is interest charged on loans and interest given on deposits, is the primary source of income for the banks. And this is also the profit of the banks. Why people require credit? Now, credit means loans. People require credits or loans to fulfill their needs. And when compared to past, people's requirement for credit has increased. Why it increased? There are many reasons for this increase in requirement of credit. Before, in agriculture, farmers only supplied most of the inputs. Farmers only supplied all the inputs, like they had their own seeds, and they used their own cattle to plow the fields, and their own family members, they worked as labor in the fields. So all the inputs were supplied by the farmers themselves. And family members only worked as labor to do all the agricultural activities like sowing seeds, manuring the farms, etc. Whereas new farming system requires more cash in hand. Now they need more cash in hand to buy seeds, fertilizers, pesticides. They have to use all these things to save the crops from pests. So they have to buy seeds, fertilizers, pesticides, everything from the market, and they have to pay to the labor, because now they are employing labor. All the members of the family, they are not engaged in agricultural activities. Some of the members, they are migrating to towns and cities to work in the factories. So they need labor. They are appointing labor, and to pay for the labor also, they need money. They need appoint labor for threshing, harvesting, etc. and they have to pay to the labor. For all these things, they require money. And another important reason for increase in the need for credit is availability of a variety of consumer goods in the market, and also attractive arrangements for finance. And you might have heard of zero finance. Without paying any cash, you can buy goods from the market, and further very low EMIs you have to pay every month. And manufacturers and sellers in the market encourage people to buy their goods by paying initial cost of 3,000 or 5,000, and thereby the remaining balance can be paid in easy installments. And nowadays they are giving an advertisement that the first installment will be paid by them also. You might be knowing about some of these companies. And an employee earning a fixed income every month finds it very easy to buy in installments. He can clear the loan within 2 or 3 years. And also people borrow money to meet their expenditure, to pay children's school fees, for meeting health expenses, or for any other functions in the family like marriages. They borrow money. And as trade and business develops, the requirement of loans also increases, because they want to earn more and more profits by increasing their investments. So they require more loans. So their credit requirements are increasing. Now let us see two different credit scenarios. Credit means loan, already I told you. And two credit scenarios, two examples are given here for credit arrangements. First example is, during a festive season, Alisha, who is shoe manufacturer, receives an order from a large trader in town for making 3,000 pairs of shoes. Within 1 month he has to complete. And now Alisha has to buy raw material, that is leather. For shoe making we need leather, so that is the raw material. And to buy this raw material he needs money. And also he has to hire workers, he has to appoint labor for stitching and pasting work, because these are 3,000 pairs of shoes, not an easy work. So he has to appoint labor to complete the work within time. So now let us see how Alisha manages the situation. He takes loans from two sources. First, he asks the leather supplier to supply leather now, and promises that he would pay him later for leather when he receives payment from the trader. That is one way. And secondly, he obtains loan in cash from the trader who gave him the order for 3,000 pairs of shoes. From that trader only, he obtains a loan in cash. He takes cash from him as advance payment for 1,000 pairs of shoes. For 1,000 pairs of shoes, he takes an advance payment from him as a loan and promises to deliver the goods within time. And at the end of the month, Alisha is able to complete the work. He completes all the 3,000 pairs of shoes and delivers them to the trader, and also earns a good profit. And thus, he is able to repay the money that he had borrowed. Now, credit is an arrangement which refers to an agreement in which the lender supplies money or goods and services to the borrower in return for the promise of future payment. Remember, credit is only an arrangement. And what is this arrangement? The lender supplies money or goods and services to the borrower, and he has to pay back the money. He has to promise that he will pay back it in future. On that promise only he supplies money or goods and services. That is the agreement. And in the above example, Alisha takes a loan to meet the working capital needs of production. Working capital means money and raw materials, these are called as working capitals. And to pay for the labor, he needs money. To buy raw material, we need money. And the same money cannot be used again and again in industries, because once we buy means we are giving it to in the market. So money, suppose our raw materials we are using. By using leather, he is making some shoes. The same leather cannot be used for making other shoes. So once used, money and raw materials, they get exhausted. We cannot use the same again and again. So these are called as working capital. And to meet the working capital needs, Alisha takes a loan to pay for the labor, to buy raw materials, etc. from the market. And here, the credit helps Alisha to meet his needs and complete the production on time, and also increases his earnings by making profits. When he makes profit, that means his earnings are increasing. Now let us see another example of a small farmer, Swapna. She has only 3 acres of land, and she grows groundnuts in that land, and she takes a loan from the money lender to meet her expenses of agricultural activities, and the money lender charges a very high rate of interest on the loan. She hopes that after harvesting the crop she can repay the loan and she can earn profits, but that year the crop fails due to pests, and though she uses costly pesticides to control the pests and save the crop, it goes in vain, and Swapna cannot repay her loan amount by the end of the year. That means loans plus interest, the debt grows over the year. Debt means appu. She has to pay back the loan amount, and also she has to pay interest. And since the rate of interest is very high, loan plus interest, the debt becomes larger and larger over the years, and it becomes a large amount to be repaid. And next year, again, Swapna takes a fresh loan for cultivating in her land. First year, she lost her crop. Due to crop failure, she could not repay the loan. And next year again, she has to take a loan for cultivating in her land. And this year, it is normal crop. That means not surplus to earn profits. It is only normal crop. Of course, there is no crop failure. So, she cannot clear the old loan. Now, she is caught in debt. She could not repay the old loan, and she has taken again loan to start cultivation, and this year it is only normal crop. And because she could not repay her old loan, and again she took another loan, in this situation she has to sell a part of land to repay the loan. That is the only alternative left with her. If she sells away some part of her land, she can repay the loan. Now in rural areas, people mainly take loans to meet the needs of crop production. In rural areas, mainly because the main occupation is cultivation or agriculture, people take loans to meet the needs of crop production, which involves money spent to buy seeds, fertilizers, pesticides, water, electricity, repair of equipments or machinery, if any. And there is nearly a minimum gap of 3 to 4 months' time between the time when the loan is taken and the time of harvesting. Before the cropping season, they take the loan, and after harvesting, they have to pay back. And in between, there is 3 to 4 months' time. And generally, farmers take loans in the beginning of the crop season, and they repay the loan after harvesting when the money is in their hands. And repayment of loan mainly depends on the income from farming. If they get more income, they can easily repay the loan, otherwise they cannot pay. So if the income of the farmer decreases, he cannot repay the loan. Now thus, we can see that in Swapna's case, due to failure of the crops, she could not repay the loan. And ultimately, she had to sell a part of her land to repay the loan. And unlike Alisha, in Swapna's case, credit did not help her increase her earnings but pushed her into debts and worsened her condition. In one situation, like in the case of Alisha, credit helps to increase earnings. So, the financial condition of the person is better. In another situation, that is Swapna's case, credit pushed her into more painful conditions. Now, the next topic is terms of credit. Now, let us see what are these terms of credit. There are some conditions laid down by the lender to give a loan. Always, whenever we require loan, we have to fulfill some conditions. And these conditions are called as terms of credit. And first of all, every loan agreement specifically mentions the rate of interest. When we take a loan, we have to pay interest on that loan amount. That is the first condition. Interest to be paid on the loan amount. And it must be agreed upon by the borrower. And secondly, the lender may demand for collateral. Now let us see what is this collateral. Collateral is an asset that is owned by the borrower, such as land, buildings, vehicles, livestock, bank deposits, etc. And these are used as a security against the loan. All these land, building, vehicles, livestock, even bank deposits, all these are used as a security or guarantee against the loan taken. And if the borrower fails to repay the loan, the lender has every right to sell away the asset which has been placed as security by the borrower. To recover his loan amount, he can sell away the assets which are given as guarantee. And in simple, collateral is an asset which the borrower uses as a guarantee to a lender until the loan amount is repaid. The third condition for sanctioning credit is documentation requirement. That is, the borrower is made to sign some documents. And the fourth condition is mode of repayment. How the borrower is going to repay the loan, in how many installments and in how much time he is going to pay. This is called mode of repayment. And this must be agreed upon by both the borrower and the lender. So, these four are the terms of credit. What are those four? Interest rate, collateral, documentation requirement, and mode of repayment. These four are called terms of credit. And these terms of credit, they vary from person to person and from one credit arrangement to another credit arrangement, and from time to time also they vary. Now, variety of credit arrangements are made in villages. Now let us see some of the examples. What are those variety arrangements? Vasu is a small farmer. He has a small land of 1.5 acres and he needs loan for cultivation. He takes loan from an agricultural trader in the village at the rate of 3% per month. That means 36% per year. And at the beginning of the year, the trader supplies all the inputs of the agriculture on credit, and Vasu has to repay the loan after the harvest. Besides charging 36% interest per year on the credit, the trader also makes Vasu promise that he would sell his crop only to him. And generally, after the harvest, the crop prices are low. And as per the promise, Vasu has to sell his crop only to the trader. And the trader purchases the crop from Vasu at a cheaper cost and sells it in the market when the prices rise. Now the trader gets lots of profits. This is one of the examples for variety of credit arrangements in village. We'll continue in the next